Okay. Hi, I'm Peter Rose, founder of Longwood Currency Trading. I wanted to take this opportunity to talk a little bit more about the discussion I had in the last video about exit methodology. I'm not encumbering anybody with how I make my coffee. Our coffee pot shit the bed, and so we've had to do pour over coffees, and it's just a process. And I won't bore you with that again today. It is a beautiful December 2024, a wonderful day to talk about exit methodology. In the last video, I talked about the when of exiting a position. This is more of a story of a position that I was in where it was an interesting thought process that I went through that would be, I think, instructive for those of you who watch my channel, basing how I trade based on the structure of the rules and the conditions that I have and all that sort of stuff. So this is more of a methodological discussion of exit process than it is saying, well, my conditions met and we get out of the trade. Underlying all of it meaning the full life cycle of a currency position from entry analysis, position management, and exit methodology. Throughout the entirety of it, each phase of the life cycle of a currency position is dependent on the previous one, and it sets the groundwork for the next one. You go from entry to management to exit. That just makes sense. But I don't think a lot of the folks that watch my videos really appreciate the sophistication of that simplicity. And I don't want to get involved in that today because I just want to talk about the methodology that goes on within one of those phases. And exit methodology is the easier of them to determine. But within that ease is complexity in itself. I mean, it's easy the way that my conditions for my rules set it out to be, but it's complex because there's a lot of emotion involved and a lot of runtime analysis that you're doing in order to get the. I mean, why are you exiting the trade? You're either getting out because you're stopped and you're getting out at a loss, or you're exiting because of a profit target or because you don't think it's going to get to the profit target and you want to get out early, or it's gone beyond the profit target and you're riding a stop behind it. The two boundary conditions of an exit methodology are simply your entry limit stop and your profit target, the limit profit target that takes you out of the position. Those are the two boundaries that we've got in discussing exit methodology. So within that period of time, that's a long time. You're going from your entry level and price, obviously, it's 50-50 jump ball for each check that it's going to move, although you have some kind of a probabilistic estimation. If you're in a long trade, for example, that the price action is going to take that price in an upward direction. Generally speaking, you're not going to enter the trade and it goes 10 pips and you're out, or 20 pips or whatever. Because I'm a day trader, I'm not really expecting to get more than 20 pips. I'm looking for 20 to 30 pip free real estate for that price to move around without impingement from price action structural constructs, as I discussed in the last video, so that I'm not in the price, the view of the position to the profit target is uncluttered. Now, whether the momentum is like a car, you look at the road and you say, oh, okay, there's no trees across the road and all that stuff, so I've got a clear path to get from point A to point B. The issue is, do I have enough gas to get there? And do I have enough momentum in that car in order to get it up the hills, in order to get over the hill and beyond and to the profit target, right? I mean, it's a stupid analogy, but it's very applicable to what we're talking about. So when you're driving that car, there's the profit target. I got a good profit target. Let's say I'm on a hill. I don't have enough gas and the car starts to back up. Well, how far do I let that car back up before I set on the brakes and get out and take a walk and go to the gas station, try to get more gas? Or whatever you're doing. If you got an EV, put your solar panels out and see if it heats up. So even though I've got my position action plan all set up, I know what my entry criteria is going to be. I know what my management process is going to be, even though there's real-time stuff to do involved in that. And I know what my exit should be. And so I'm looking at that exit, and I'm moving toward that profit target. What's going on in our heads as traders? One of the conditions that is difficult for us is to let the profit run, let the position run. And it's particularly difficult for a day trader because look, if you take 10 pip profit every time, and you take a 10 pip loss every time, and you're a 50-50 jump ball trader, you're still gonna come out okay, but not very good, right? You're living, you're jump ball. A 60-40 trader, you're gonna come out with, let's say you're trading a full lot, you lose 10 pips 4 times, you get $400 in, you win 6 times, 10 pips, and so $600 you win, $400 you lose, you get $200 that you've won over the course of the 10 trades. The process of trading itself on each individual one of those trades, you're saying, I've got this profit going, and I've got to capture this. I'm afraid of losing that because my net gain over a 10 trade series where my statistics play out, or 100 trades or whatever they happen to be, but you're still fretting over that one position that you're dealing with. You've got the entry going and it's moving along and it's going toward the profit target, and then it sneaks back 3 or 4 pips on you and all that other sort of stuff. You know that you're in a day trade. You're not going to be there for 4 weeks to have the thing decide what it's going to do. I mean, do you want to sit with a trade for 4 weeks? Well, if it's ripping and going like crazy, just run a stop behind it and let it go for 4 weeks. That's fine. How often does that happen, though? How big of a loss are you willing to take in accumulated gains before you exit the trade with a stop? When you have a runner, what's your profit target? How do you calculate that as it's going? So what I'm getting to is that even though the trade is successful in the extent that it's moving in your direction, you still have this fear of losing pips, particularly as a day trader. You say, well, I've got a free runway for 20 to 30 pips, 25 pips, let's say, and statistically I'm going to get, when I get them, I'm going to get 12 or 15 of those pips because I've got to, when I identify my entry criteria, I'm not going to get in right then. I've got to let the price come to me. Well, how far from the current level where I'm 25 pips away from the profit target, or 20 pips away from the profit target, how long am I going to wait before I pull the trigger and get into the position? 5 pips? 8 pips? I've waited 25 pips before I've entered a position. But then my profit target was 20 pips beyond that. Or maybe I was just looking for that big momentum jump and I was only looking for 3 pips to get out. Those are conditions that have to be met within your rules so that you're not trying to figure that stuff out in real time. But you're sitting there with this successful trade that's moving in the direction that you set it up. It's going in a positive direction. In this case, if you're a long trade, you're 5 pips into it. You had to wait 5 pips to get in the trade, let's say, boom. You've got 20 pips in your free range area. You chewed that 5 pips of that up. You got 15 pips to run. You're probably not going to get to the full 20 pips because you're looking at zones and you don't know what's going to happen. You know, again, it's like that car going up that hill. It goes up and it goes up, it goes up, but it just may not have the last bit of energy to go over, get to the top of the hill, and you're going to have to hit the brake and stop and wait till the engine cools down or whatever it is. It's preventing the car from climbing that hill. We've all experienced that. So that's fear. Your fear of losing pips. Well, if you were a long-term position trader, Peter, you wouldn't have to worry about that because you'd be looking for a 200 pip profit target and you'd be going along there. And so what difference does it make if you lose 10 pips? Well, I tell you what, if you're doing long-term position trading on anything less than 10 lots, you're really wasting your time because you're not going to get paid for the time that you're in the trade. And so when that thing comes back, this 10 pips, that's $1,000. Are you going to be able to let go of $1,000 of win? What are you going to do? Are you going to say, oh, no, I can't get out, I can't get out? That's the same thing as is the trade going against you when you enter. Oh, it'll come back. And you're looking at a profitable trade, and you're going, oh, it'll come back. Well, maybe it doesn't come back, and you lose another 10 pips. So you look down at a day trade thing where that thought process is happening within a 20 pip range, and you look at it at a long-term position trader where you're looking at a 200 pip range, it's still 10 pips, 20 pips. And it still is fearful. And you tend to want to get out sooner rather than let that price come down any amount. Because particularly in the day trading scenarios that we're involved in, you've got 15 pips between where you actually got into the trade and this thing here, and you're going to lose 5 pips at the profit target level because of the zone. So now you're down to a 10 pip run. So the thing is now 8 pips in your favor, or 5 pips in your favor, and you're going, oh, I should take this because I don't know if it's going to get the next 5 pips. I'm out. Well, then that thing goes another 10 pips. It goes beyond the profit target. You lost out 10 pips. You got 5, that's great, but you lost 10. Well, you didn't lose it, but you didn't take it. So you lost it. It's called lost opportunity. If you don't sit down at the trading desk every morning to look at what's going on, that's a lost opportunity because if something had been going on, you would have missed it. You have to be present in order to do this stuff. You can't just sit at night and go, oh, it's 5 o'clock close, I'm going to set my things and to go off to bed. That's not the way that you trade. That's the way you can invest, but that's not the way that you can trade. If you want to invest, then there's far better vehicles for you in order to do that. Vanguard No Loan Index Fund is pretty good at 8%. Over a 20-year period of time. You make 8% a year. I've made 8% in a month. I made 2% on my risk yesterday. So you're choosing currency trading because in a shorter period of time, you can make larger percentage gains than you could in any other investment vehicle. I particularly happen to like currencies as opposed to you could do the same thing, talk the same thing. You trade derivatives, trade options, trade commodities, other kinds of future things. You could trade the DAX, the S&P, all kinds of crap. And it's trading and it's short term. And if you know what you're doing, you can accumulate large percentage gains against your bank. Well, what do you want to do? You want to be a penny stock trader, and all the information you have to have about that particular company and that particular industry with their accounting rules and all the other stuff that's driving the thing. And then you're waiting for the president of the company to come out with the fact that he's inflated the value of the sales, and that's why the stock price is up. Yeah, that's what you're going to wait for. That's the work you feel that you have to do. And with currencies, you don't have to know anything. It's my position that you shouldn't be doing technical analysis, and particularly you shouldn't be doing fundamental analysis in currency trading, particularly as a day trader. If you're going to do a long-term position trader, well, you better be aware of what the economic releases are and certain economic conditions. You're just cluttering your head with shit that you have no control over knowing. You think you've got to know all these fundamental things if you're going to carry a trade for a couple of weeks, but you don't. You just have to know how to trade and put the thing together. I don't want to do that, because if I carry a trade for, let's say, a week, I've got a 200 or 300 pip profit target, and I carry the thing for a week, and it's moving in the direction, and it comes back, and it goes down, and finally there's this big draft of 10 or 20 pip retracement, and I get out after a couple of weeks. So I've made 50 pips out of the 200. So you multiply 50 pips times the value of your trade. Let's say you're trading a 10 lot. So what are you going to do? You make, or one lot, let's just make it easy. You make 50 pips on a lot, you're $500. So now you divide the $500 by the number of days that you were in the trade. 20 days, you're making $20 a day on a, I mean, was that worth that when you could have made $500 in 2 days of trading or 4 days of trading with that one full lot? Well, I don't think so. Again, we're talking about exiting. We're talking about profits. How do you come to a rational and reasonable estimation of what your value is as a trader, the skills that you bring to the table to do that trading, to make that money? And how do you evaluate what the market is going to be able to present to you so that you can achieve your goals? There's this dichotomy. I know what I'm doing, but I've got a market that's random and chaotic, and I've got to mix, I know what I'm doing with that random and chaotic market in order to determine that I'd like to make 20% a year on my money, or 40%, or whatever you think that you can make. You know, you see these guys making, some of the videos are making 300% a year. Yeah, they're jacked up at 200 to 1 leverage or 500 to 1 leverage. They've got 10 years of experience and they know how to juggle it, and that's great. And you think you're going to take your 4 minis and do that? Nah, I don't think so. You think you're going to take 2 fulls or 5 fulls at 200 to 1 and make it? Nah, you're not. Because once you hit 3 or 4 losses in a row at 200 to 500 to 1, your money's gone. Your account's empty. Gone. You start with a small account and you gradually build up profits and you increase the size of your bet at 200 to 1, and then you lose. Yeah, there's no, that's insanity. You have to look at risk management. These guys out there aren't doing risk management. They set stops. That's not risk management. Risk management is pages and pages and pages of coursework and hours of discussion. I just got off a video conference the other day. Thank you for your time, Solomon, where we were talking about risk management. We spent a lot of time talking about risk management in a consulting session. We were on consulting for an hour and a half. And it's backed up by, I've got some documents that I need to send to him, but they're not as extensive as they could be because it's not ready for that stuff. But these topics are involved. That doesn't mean they're difficult. It means they're involved. Driving a car is involved, but it's simple. right? I mean, a car is a really complex thing, but do you need to know the theory of combustion in order to drive your car to the grocery store to get a good bottle of wine? No, you need to know how to turn the car on. You need to make sure there's enough gas, put your seatbelt on, and go to the fucking store. Why is trading being made so difficult? It's because people don't know how to organize their thoughts about the trading. They don't know how to solve the whole problem on an incremental basis in what I call process-oriented trading, such that the plan itself is simple. When you have a simple plan, it's very easy to go, well, this doesn't look like what the plan says that should look like. I'm out. And that's the key that I want to get across in talking about exit methodology as a process, as opposed to, oh, well, you get out at the stop or you get out at the PT, and if you're going to do a runner, you float a stop behind him, and hey, it's a good day, have a cup of coffee, and life is good. If it was that easy, then why do 90% of the traders lose 90% of their money very quickly? Why is that? Why does that happen? Well, some of them are just stupid. There's a huge component of those that really don't know what they're doing. They're getting bad education, and they're trading at 200 to 500 to 1. Almost everybody I talk to is trading at 200 to 500 to 1. They wonder why the fuck they're not winning any money. Do you know that in the study that a large FOREX broker did many years ago, over 25,000 of their clients, 43 million transactions, they determined that 90% of the traders lost 90% of their money in 90 days. The caveat to that is that 72% of those traders that lost money, those trades, 72% of them were profitable. They had a profitable win to loss, but they still lost money. 72% of their trades were in the money, and they still went broke. Why is that? Because they don't understand process. They don't take the time to learn the stuff right. They think they can go take a $500 course on Udemy or something and watch 55 or 15 videos and read a 20-page PDF file. No. I'm just telling you, no. Could you get a high school degree by not going to high school? By just reading the books? Could you get a degree in math in college by reading the books and doing the exercises? All the information is there. The teacher's just going over the stuff. What's the difference? Why do you need a teacher? Fire them all. Education's free. Go out and buy a $40 book. You can learn it on your own. Well, once you're educated and you understand process, that makes it feasible for you to be able to do that. But if you're just trying to start out to learn a skill, there's so much information just about that skill that you're going to have a hard time putting all of that aside and figuring out what are the key pieces that you need to know. How would you know if you don't know anything about really about trading? That's not degrading you, but you know, you get in there and you're trading away with your 1 or 2 full lots, and you're making money and you're losing money. And I've had people call and say, well, you know, I'm almost consistent because I'm doing this. I go, well, okay, what are you doing here? What are you doing here? What are you doing? Well, I don't know. What does that mean? Well, you really don't know what you're doing. The statistics are simply just working in your favor. That's all. Oh my God. The bow dog just went crazy because we just got an Amazon delivery. This is a new camera, by the way, that I'm using. And I didn't get all the pieces that I needed for it. So I had to order 128 gig SD cards for it. And a couple of batteries, minor stuff. So he's upset about that. I'm happy that I got it. But when you get to the point in this viewing of the education, you need a mentor to say, this is the important stuff, this is the important stuff, this is the important stuff. Okay, let me show you how to organize it. Let me show you how to sequentially organize it. And then let's show you how to use it by process, not just by, oh, I need to close the trade today, so I know how to hit the bid ask on my trading platform. Well, it doesn't make any sense. So there's a methodology to even the simplest of appearing things. You look at exit methodology and say, well, you know, if it hits my stop, I'm out. If it's my profit target, I'm out. But you're not accounting for your emotional attachment to the gains that you have and your fear of losing those gains, as opposed to having a desire and a want to see if the thing is going to go all the way to the profit target. And you have to be mature enough to say, oh, here are the reasons, the conditions in my exit methodology rule that say that if this happens, or this happens, then I shouldn't wait for the profit target to hit. It's simply not going to get there from a probabilistic standpoint, so I'm just going to cut it and run. And that's what I did in yesterday's trade that I was in. And I think I discussed this. I had a profit target, 28 pips out. He goes, Peter, what are you doing? You know, you're in a day trade. You're talking about 20 to 30 pips of profit, and you're lucky to get 10. Yeah, okay. Well, I'd been through a couple of small losses, and I finally got it right. The price took off. I went boom, 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 added into the position. The thing just kept on going. It came back up. It fluttered. I understood why it was fluttering. I hung with it. The thing went against me a little bit, and then it went, it dropped like a fucking stone. So I walked away with $800 for 20 minutes of work. However, it didn't hit my profit target because I was there watching it on a 5-second. And it went to, oh, I think it was 23 pips or 24 pip, it was 28 pip profit target. And it started on that 5-second chart. And I went out to the 1 minute, and it was looking like it was going to keep going up. And I cut it and got out. And I got $800. Not a bad trade, because I was trading with a small bank. So even with a small bank, you can make money if you time it right. But you can't fall in love with it. You got to get out, even though you've lost. I figure that loss cost me $500. That's where that price was going to go. That was what I was shooting at, and I saw a little blip back, boom, and I'm out. And that was a fast pullback too. I looked at it for the rest of the day, see if I could pop back in. The conditions didn't present themselves. I didn't trade again. I'm looking today at the pricing. Actually, time has gone by. The economic news came out. I don't know what happened with the price. I should probably go back in and see if there's a trade to take for the day. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.